Hello and welcome to Connected With Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Scott Craig. I'm a corporate partner in the Emerging Companies Group in Latham's Austin and Houston offices. I advise emerging growth technology and life science companies, their boards, and their investors on a full range of corporate transactions in high growth industries, including our topic today, energy tech. In this episode, we're going to discuss the emerging space of energy tech, what it is, how these companies are getting funded, the unique challenges that these companies face that most venture companies don't, and how we at Latham can help connect the dots between the emerging company entrepreneurs, traditional energy investors, and infrastructure companies that they might want to talk to as they grow. To discuss this topic, I'm going to be joined by fellow partners Josh Bledsoe and Spencer Ricks. Josh is a partner in our Orange County office. I'll let Josh introduce himself.
Hey, thanks, Scott. Happy to be here. Happy to speak to this topic. Certainly found myself doing a lot more collaboration with you guys the past few years as we see energy tech emerge. So yeah, I'm an environmental lawyer by training. I sit in our environmental practice group, but I'm more broadly an energy transition lawyer. So really anything that touches on energy, climate, or emissions, that's really what I do. That's sort of the connective tissue of my practice.
Spencer is a partner in the corporate group in our Boston office. Spencer?
Thanks, Scott. Happy to be here. So yeah, I'm Spencer Ricks. I'm a partner here in the corporate department of Latham in Boston. I represent, kind of like Scott, I represent startups, companies, and founders and entrepreneurs through all stages, from formation through financing, strategic collaborations, hiring and firing people, and then eventually, M&A acquisitions, licensing transactions, and then IPO, M&A, de-SPAC, and beyond. So it's a very broad practice. And I've kind of come into, a lot of these energy tech and decarbonization and climate tech companies a little bit by happenstance, but it's been a happy accident. And I'm happy to be here and to talk about, some of our experience and clients in the area.
Thanks, Spencer. I think one of the first questions is, as we've started to talk about energy tech as a practice area, and the question we get a lot of the times is, what is energy tech? How are we defining it? What differentiates it from, say, climate technology or climate law or energy transition generally, or energy and infrastructure? I know I have my thoughts, but Spencer, given you're also an emerging company attorney, how do you see how we're trying to define this space?
Thanks, Scott. It's interesting. Obviously, myself, I'm coming more from a startup VC-backed company background, representing, primarily companies. And so for me, right, who works across industries and practice, right, like I have clients around the globe, geographies and industries in lots of different areas. And so for me, this is sort of another area of practice and just another area that my clients happen to be touching. But there certainly are a lot of considerations that are specific to this area, including, who are the VCs that invest in these companies, what the life cycle looks like. Again, there's a lot of commonalities with other companies across industries, but there are also some practices and sort of best practices that are unique to the space and investors that are unique to the space, and things that, founders need to keep an eye on and think about, if they're going down this path of, an energy tech company. Right. I think that one of the biggest takeaways for me has been that there's more commonalities than there are differences. Right. Perhaps there was a time when there was a thought that, okay, if you're in this energy transition or energy tech space, that you have to follow a very different path. Right. You have to, only go to these types of strategics or only, do things this type of way. But it's been really interesting to see that we're seeing a lot of companies getting funded through kind of more traditional VC pathways, and then bringing in strategics along the way and other partners. So it's been fascinating to see, but it's certainly a pathway that is robust and becoming stronger and more well-trodden at this point.
That's super helpful. Being in Texas, one of the things, and also an emerging company attorney, one of the things that's become obvious is the role of Houston. And when I talk to attorneys in Houston, where, venture capital is not as big of a player, it's growing as a technology city, but these companies often have a hard time trying to find ways to raise money, but they have a growth pattern or a growth sort of, cycle of a typical venture-backed company. And it's not like a big oil and gas company that's coming up with the technology. These are entrepreneurs seeking to raise funds for a company that they want to continue to control. And so when I think of energy tech, I really, similarly think of it as not so different than the software and AI and life science companies that we've represented over the years in the venture capital space. It's just that they're servicing the energy space. And it can be something as simple from my perspective as a software as a service that's servicing the upstream oil and gas industry. But for the most part, I think what we're also talking about are new sciences and new technologies that are facilitating or disrupting the current energy market. And as we talk about that today, Josh, one of the things, given you've worked both with very large organizations and now are working a lot with emerging companies, talk about a little bit about some of the transactions you've seen with emerging companies where you've seen them maybe even struggle to branch out of the emerging company space and into larger energy and infrastructure type deals and projects.
Yeah, thanks, Scott. I mean, we're certainly seeing these companies get funded in different ways, and of course, you and Spencer are both the experts on VCs and incubators and things like that. But we are seeing a lot of strategics getting involved with these emerging stage companies. We're seeing private equity shops get involved as well, which is interesting. Outside of directly investing in these companies, oftentimes they're providing sort of an indirect financial benefit by being off takers. And what I mean by that is you could have a startup company that is producing some sort of new low carbon fuel. And to have a credit-worthy company that's saying, yes, we will buy your fuel once you build the facility and we'll pay you 20 years for that fuel, that allows these companies to access capital. What we're also seeing a lot of, and Scott, when we were preparing for this, I think we talked some about it, the strategics, which have been heavily invested in traditional forms of energy, oil and gas, et cetera, for many, many years, literally hundreds of years, they are very interested. Almost every one of those have some sort of arm, a low carbon venture arm, that are looking at these types of technologies and these types of companies, and they're making direct investments. They're also collaborating in other ways, joint ventures and things like that, to pursue these technologies, pursue these projects. And there's been some criticism, and you'll see this across the trade press and even the popular press, of so-called greenwashing. These large strategics are just getting involved with these companies just to have something positive to say on their website, right? They're not really engaged in this space. And I don't think that's true at all. And I think we got to be really careful. There's so much capital that needs to be deployed to stabilize the climate that we can't let the perfect be the enemy of the good. I mean, funders of traditional energy, developers of traditional energy, they have so much expertise and experience in the sector and access to low-cost capital that I don't think we can just rule them out entirely and say, thou shalt not allow these types of companies to be involved in the funding of energy tech. So I'm hopeful that we can be broader on that.
Josh, I completely agree. I mean, we're seeing with these companies, right, these energy tech companies, we're seeing involvement from strategics at a much earlier stage than, like a traditional SaaS or AI or even life sciences company. It's because of those other opportunities, right? Opportunities for strategic collaboration, opportunities for investment directly at the project level, opportunities for offtake arrangements, right? But yeah, no, I totally agree. Don't look the gift horse in the mouth, right? And when the capital is available for these young companies that are changing the world, I mean, I'm happy to see strategics get involved early, and they're a super important source of capital, and just opening up their Rolodex, right? Opening up their network to opportunities for these young companies. And frankly, they can be a bit of a validator too, right? When a big name strategic makes an investment in a very small company, suddenly the profile of that company is raised and they have a lot more opportunities and doors that are open to them. So totally agree 100%.
And I think the other thing that the strategics allow, especially the strategics that have the logistics and the capacity, and they allow these companies to scale faster, regardless of how they're investing, whether it's as a straight sort of venture investment or it's at the project level. It's really hard for an energy tech company that's in, especially if it's in the supply chain at all with respect to energy, whether it's transmission, development, or whatever, to plug into the supply chain without a strategic that's going to find a way there. Sort of on this topic, we talked earlier how we see energy tech as sort of the venture-backed side of energy tech and entrepreneur-driven, things like that. Again, typically when we think of entrepreneur-driven companies, we are thinking venture capital, minority investments, maybe several rounds of investing, always dilutive at the top, when we think of venture-backed companies. Spencer, I know you've had experience with at least one client, but talk a little bit about where sort of energy tech as a company grows and succeeds can divert from what we typically see in venture, particularly at the project level where you've seen success there.
I'm happy to speak to that, Scott. So, I mean, you get these strategics involved, and a lot of times they are looking to make an investment at the project level, which is unique and different from most other startups, right? With most startups, the traditional model is, you find investors, they invest at the top co entity, and they're kind of investing in the whole enterprise through the top co, right? But with a lot of these, energy tech companies where they're creating projects, they allow opportunity for investors to invest directly into specific projects, right? Because there's certain projects that are of particular interest to particular investors, right? Primarily strategic investors. And so it is a really special opportunity to be able to kind of segment out the investment opportunity. And so what we often see is investors, primarily strategics, make an investment at the project level or have an option to make an investment at the project level, but also simultaneously make an investment at the top co level. So they're kind of hedging their bets a little bit. They're investing directly in the project or projects that interest them, but also, investing in the top co because they recognize that the overall enterprise, they're kind of hedging their bets a little bit, but also just, giving a couple of different pathways for capital for the company. So, as these projects are very capital intensive. And so being able to offer the ability to invest directly at the project level opens up large amounts of capital that otherwise might be limited if you were only telling folks, hey, you can only invest at the top co level and you got to invest through that top co in all of our projects. So it opens up avenues of capital that might not be available, but that are necessary, I think, to fund such large scale and large projects.
Yeah, Spencer, thanks for talking about the project finance aspect of it. I think that's really important. It circles back to something Josh was talking about earlier. But Josh, when you see these projects, talk about the different parts that Latham brings to the table as it relates to project finance, ELR, offtake agreements, where kind of everything comes together.
Yeah, sure, Scott. Happy to do that. There's a lot of challenges that these types of companies and projects face that you don't, I would think, traditionally see with other venture type companies. It's Spencer touched on this. They're much more capital intensive. You're building hard infrastructure, versus, building or developing the proverbial app to go on someone's phone. And because of that, you also have a much longer timeline for your return on investment. I mean, a lot of these projects require multiple years, if not decades, to get the full return on them. So let's say you're building a new type of power plant or some sort of renewable fuel production facility. The payback period oftentimes can be quite a bit longer for investments in these types of companies. Of course, there's all sorts of exits, I'm sure, that are earlier that you guys are experts on. But generally, when you have more traditional project finance, the payback period is quite a long time. And again, for those listening here, project finance is basically funding and development all at the project company level, and all of the permits, approvals, assets, revenue streams, everything need to feed into that one project company. And then the returns for the folks that are funding that project company come in over time as the fuel is sold and you have the offtake agreements that are effective over that period of time. And so that makes this sector different. It also is a sector that's highly regulated. So the energy sector generally has all sorts of regulatory structures to comply with. I mean, you have heavy involvement in the energy sector from gas and electric utilities. A lot of those are regulated by state level public utilities commissions. Pricing is regulated, things like that. Energy efficiency standards, there's environmental regulation. There's permitting, which can be very time consuming and a robust endeavor if you're trying to build hard infrastructure. And there are trade-offs. A good example, I would say, is, hey, we have a new type of company. We're going to produce hydrogen and we're going to combust it to make clean energy. Well, that's great in the sense that you're reducing greenhouse gas emissions and addressing climate change. But when you burn that hydrogen, you could have air emissions from burning it. So much like anything in the energy sector, there are trade-offs. We want to build a new transmission line, reconductor a transmission line. Well, you could have habitat impacts. You could hurt the proverbial bugs and bunnies when you're doing that type of work. But there is this other benefit of a more robust grid, energy resiliency, and things like that, which can lead to climate stabilization. And so those types of considerations are pretty standard fare in the mature energy sector. But I think for emerging companies in energy tech, sometimes there's a bit of a learning curve, including, I think, on the funding side. in terms of expectations. And with that, probably flip it back to you guys in terms of, what you may have seen from providers of capital.
Josh, that's absolutely right. I mean, it's always important. I tell all my clients across all sectors, right? Like it's important to find the right investor partners, right? And to think about it like a partnership, not just a checkbook. But, a good investor is truly a value add. It's a trusted partner. It's someone that's so much more than just a checkbook, right? But all the more reason in this space, right, in these energy tech companies to make sure that your investors understand, exactly what's involved and the timelines that are involved for the creation, but also and construction, all the different aspects, like you said, multi-year, multi-decade in some cases, right? And also the return. If there's a VC investor that's expecting to get a full return on their capital in 3 to 5 years, that might be a tough fit for a company that's heavy in the project space and needs a lot more time. So making sure that your investors understand what the timeline is for construction, for creation of the actual project, and then also for the return on investment is critical. And another reason why having some strategics around the table, folks that know the space really well, can be helpful in terms of educating. So it's not just on you, the company, to educate some investors, right, who maybe are a little bit newer to this space, but also having other investors also educating the investor cohort. So it's really important to make sure that the folks that you bring in understand exactly what they're getting into when they invest in this company.
It's interesting, Spencer, you talked about the right type of investor, and what we found in Texas, and it's been wonderful having a Houston office to work with that's just so deep in the energy and infrastructure world. We've seen a lot of investors that traditionally would invest in old school upstream oil and gas, whether it's private equity or family office or not or whatnot, start to look at energy tech the way we're explaining it today. And it's really interesting because they're not venture funds. Venture funds have a certain model. These folks have a certain model. And we're having to explain to entrepreneurs that, these might be the right investors for you, but they're not going to have the risk profile of a venture fund. And so you're going to have to, maybe take a little bit more, some harsher terms from the investors than you might if it was a West Coast VC. At the same time, these are the people that have grown and scaled energy companies in the past, and they know how to do that in the industry. So what you're getting is the expertise. So there's a give and take there, I think. And I've mentioned in the preparation for this, Bill Gates spoke at CERAWeek in March in Houston. And one of the key things he talked about was how, he truly believes Houston's going to be kind of the Silicon Valley of energy tech, just simply because all of the money that knows how the industry works that's there and how it's shifting over time from, the traditional E&P that we think about when we think about energy and oil and gas to the energy transition. And part of that's going to be the strategics, like you mentioned.
Yeah.
Spencer, one thing I wanted to ask is, as you've seen these companies grow, what have been some of the, we've talked a little bit about some of them, but some of the headaches that they've run into in their growth?
Happy to answer the question, Scott. So, I think there are a lot of different headaches, and a lot of them are common to, startups across industries, aren't sort of unique to this space. But I think some of the headaches that are unique to this space are sort of the concept of investing at the parent company level, but also at the project level. So that dichotomy is a little bit unique. The capital intensive nature, having to educate your investors, and also, having to educate the founders on exactly what they've bitten off is super important. But I think certainly, for a company that's never done a project before and is doing its pilot project or its first project, there's a huge learning curve right there. And sometimes companies are tempted to kind of, try and cut corners or kind of skimp on that pilot project, maybe because the project's not super big, it's a proof of concept. Maybe they don't have a huge funding behind them to really do it super, super well. But the reality is that first project sets the template for future projects. And so it's really important that you set it up the right way, because those relationships, not only are they going to be multi-year, multi-decade, but they're going to set the precedent for future projects. And those future projects are going to be much larger. And, it's sometimes once you do the first project, it's hard to change the terms significantly when you do the next project, because the next project looks back at the prior project. So each kind of builds on the prior. And so, one of the pitfalls that I've seen companies run into in this space is, feeling like, okay, it's all right. The startup mentality, kind of fake it till you make it. I mean, in this space, you got to nail it the first time to really set yourself up for success. And I know it can be a little bit painful up front to take the time and effort and spend to get it right. But, all the more reason to have really, really good folks around the table helping you do it right and the right way, even the first time around when it feels especially painful because, you don't have the funding, you don't have the person power to really go all in on it, or it might feel that way. But I think helping companies understand the importance of really nailing it the first time with that first project is critically important.
Yeah, Spencer, if I can add on top of that, pile on probably. This is something that I've told clients many times, which is your $50 million CapEx project, let's say a renewable natural gas facility, digesting some type of biomaterial and making renewable natural gas. The complexity of getting that project permitted and developed, that's, all the commercial agreements, all the entitlements, everything else, is just as hard as building a $2 billion natural gas-fired power plant. And that's just the unfortunate truth, because it's essentially the same type of work that needs to go into it. And of course, at a much, much lower CapEx value. And so having that reality is quite the challenge for these energy tech companies. And sometimes the first project or two need to be a loss leader before they can really scale up. So that calibration of how quickly you scale your projects from pilot phase to demonstration phase to your commercial phase, that's something that is frankly hard to navigate, I think, for many companies, almost all companies.
I totally agree, Josh. And it's an education of not only the founding team, the folks that are at the company, but also their investors, their backers. So they also understand why the company is spending so much time and money, right, on this, like you said, what could be a loss leader type project for the company. But it's just so important to get it right the first time and every time, but especially that first time, for sure.
Yeah, I think in the startup world, there's often a lot of whistling past the graveyard and asking for forgiveness before permission. But depending on your technology and what you're doing, it sounds like what both of you are saying is that this is such a highly regulated area that you really need to dot all your I's and cross your T's.
Absolutely. In a lot of respects, there are a lot of parallels with like the life sciences industry, right? It's like, if you're a medical device company, if you're a pharmaceutical company, it's not fake it till you make it. Like, you've got to get FDA approval, right? You have to go through all these it's also a highly regulated industry. And there are a lot of parallels there. So absolutely, totally agree, Scott.
Yeah. And I think those companies that have projects they have to develop, if they're smart on the front end with project design, you can avoid some of these requirements, avoid some of this complexity. Where you build your project, how you build it, what your feedstocks are, things like that. And so early advice on how to design your project can actually make your life a lot easier and reduce your spend, I think.
Well, this has been a great conversation, guys. I want to leave it. Any last thoughts to both Spencer and Josh? Spencer, do you have any last thoughts as we close out?
It's been great. Thanks so much for having me. I just, if there's one point that's really shown through for me through the course of this discussion, it's been, the importance of making sure that you have, the right partners around the table with you to help you navigate these issues for these companies that are really kind of bridging a few different worlds of like sort of the venture world with energy and infrastructure and kind of oil and gas. It's all kind of coming together. And I think finding folks that can help you navigate all of those aspects sort of holistically is super, super important. And certainly, here at the firm, I'm super grateful to be at Latham, where we have just such deep expertise, both on the venture side, on the corporate transactional side, but also on the project side. And I know our clients really love being with folks that can help them navigate the interplay between all these different areas and practices.
Josh, any thoughts as we wrap up?
Yeah, absolutely. I think Scott and thanks Spencer. A pleasure having this conversation. I found it really interesting. I do think a takeaway for me is that, we have all these challenges that we've talked about, how hard this space is, but those challenges also present a lot of opportunities. And what I mean by that is often we see the true value of energy tech. It's hidden. It's not easy to realize the value of these companies, whether the products or services or projects. And so I do think that early front end strategic thinking and structuring and designing is really important, whether that's to figure out how we can use tax credits coming out of the federal government, whether it's how to leverage state level funding, whether you're generating environmental attributes and figuring out how to monetize those. That type of work we've seen can bring a lot of value to our energy tech clients. And I think that's my takeaway is really sharpen your pencils on the front end and try to maximize your opportunity.
Well, thanks both. I think finding a partner that can identify these issues early on, even if you're not quite there yet, is just a huge advantage for energy tech companies as they're getting ready to grow. Well, thank you both. And thanks for everyone for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcast on lw.com, Apple Podcasts, Spotify, or wherever you get your podcasts. Thanks all.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.